Hello everyone, welcome to Bhadra IAS online for Nagaland Civil Service exam preparation. Today in this video I am going to discuss inflation causes and how to control inflation. In yesterday's video I discussed concept of inflation, deflation, stagnation. You can follow that video. Today I am going to discuss exam perspective, how to control inflation and what causes inflation. So today we are basically going to look at the concept of inflation causes as well as measures by government to control inflation. So to start the topic, first let us look at the concept of inflation, which I explained yesterday in other video. So what is inflation? Generally we say inflation is a condition when prices are increasing on higher and higher level. So when prices starts to go up like this is generally what we call the condition of inflation. Okay, so normally it is a rate of increase which is considered to be inflation. Now today we are going to look at the causes of inflation. What are the causes of inflation? In economics generally we have two causes. The first one is called demand pull inflation. What is the meaning of demand pull inflation? When in the market demand is greater than supply, demand is increasing constantly and going over and above supply, there is a pressure on price to go upwards. Clear? Similarly, we have another theory called cost push inflation. This theory says that for whatever reason, if cost of production increases, it will also increase price level. So we have two basic economic theories on causes of inflation. So now if you look at this diagram, we look at the first one, demand pull inflation. So what is the demand pull inflation? How does it work? Okay, so if you look at this is your first demand curve, and this is your supply curve. Demand and supply meet here at this point. So this becomes your price level, original price level. Okay. Now what are we saying? If in the market demand goes higher, it will pull the price up. That is called demand pull inflation. So if you look at this demand curve, second one, the demand curve is shifting and going upwards. So the demand is moving at a higher level. So this shift of the demand curve touches the supply curve at the higher equilibrium point. So if you connect the equilibrium point to the price level, what happens? Here we have this much increase in price, what we can call it inflation. So the difference between the P1 and P2, this difference is the inflation created by the new demand curve. Now this type of inflation is what we call demand pull inflation. Clear now? So let us look at from exam perspective, what are the factors which create the demand pull inflation? Number one, increase in money supply. So when RBI government increases money supply, like government spends money or borrows money from RBI, then it increases money supply, right? Point number two, increase in disposable income. That is the income with the people after paying tax. So when we have more money in the pocket after paying income tax, we try to spend the money. So it creates demand. Point number three, increase in government expenditure, public expenditure. When government undertakes investment or any other expenditure, it becomes income of the people and therefore there is increase in price. Point number four, increase in consumer spending. Like festive season, some other season, people tend to spend more money. Normal, if people are increasing their expenditure, it will create pressure on demand. Number five, cheap money policy, RBI's policy. When RBI charges lower rate of interest, like bank rate, repo rate, it is called cheap money policy, expansionary policy. During this policy, money supply will increase. The next one, deficit financing, is when government borrows money for the budget deficit. Nowadays we don't have this deficit financing. Okay. Number 7, expansion of private sector, when private business makes investment, as a result income is generated, so it could also create inflation. Then we have an increase in population, simple one, black money. A very important feature of demand pull inflation is black money. So when people have unaccounted money, black money, they try to spend it in the market because they cannot otherwise do it. So that will create a lot of demand for many goods. Then repayment of public debt, mostly internal public debt. So when government borrowed money from people, if the government repays the money, it is called a repayment of public debt. If it is internal within India, it increases the purchasing power of people. And the last one, increase in exports. Okay, if too much of production is exported and very little will be available, so it will create a pressure. Now these are the factors which shift the demand curve. Clear? Now let's look at the second theory. What do we call? Cost push inflation. So what is the idea, concept of cost push inflation? As I told you, if the cost of production increases, somehow supply will reduce or supply will begin to fall. Now let us look at here. This is the supply curve 1, right? Or take 0. Now this supply cuts the demand curve at this point. So we have an equilibrium. So price level is here. If supply reduces, it goes backwards. So this second curve, supply is actually going backwards. Okay, it is going backwards. So as a result, you see supply is reducing. Say from 100 kilo to say 90 kilo. So I mean 10 kilo shortage. As a result, you see price is gone up here in the second equilibrium. So the difference between these two is what we call inflation. So inflation can be caused by demand. Inflation can also be caused by shortage of supply. Is this clear? So this is called cost push, yeah, supply side inflation. So now if you look at here, what causes the supply curve? Okay, so number 1, shortage of factors of production. If in the economy factors are very less, factors of production, it can create shortage of supply. Industrial disputes and lockouts, shut down, so there is no supply. Natural calamity, flood, earthquake, whatever, it can affect supply totally. Artificial scarcity is what we call hoarding. When big traders buy and stock products and they don't sell it in the market, it creates shortage. Increase in exports, I already explained to you. When you export a lot of things, there is nothing left in the country, so there will be supply will be much less and demand will be greater. Lopsided production means one-sided, yeah, imbalanced production. Okay, what does it mean? If everybody produces only rice, there will be no dal, yeah, no wheat. So what happens? Price will increase for wheat, dal and other things. So it will create a balance issue. Law of diminishing return, it says that if you have a fixed factors of production and you increase only labor, the returns will be going on reducing. Okay. International factor is very important. Like any crisis, like Ukraine crisis, American crisis, Middle East crisis, it affects a lot of prices of India. Right, like certain supply will be reduced, like petrol or oil or whatever. Increase in cost of production, this is the main thing in the supply curve. When cost of production, raw material, factor of production cost, if it increases, automatically price of the product will increase. Clear? So these are the factors which affect the supply curve. So inflation can be caused by demand also. Inflation can be caused by supply curve also. Now let us look at what are the measures to control inflation. For your exam, this kind of topic will definitely be asked. So generally we say there are two types of measures to control inflation. One is the fiscal policy, other one is monetary policy. Now fiscal policy belongs to the government. So what should the government do to control inflation? Government should increase direct tax, reduce the indirect tax, reduce government expenditure, borrow public from the public borrowing. Government should not repay internal debt, and government should follow surplus budget, collect more money, spend little, and government should promote more and more production so that supply side problem can be taken care, and restrict or ban on export of essential important goods. So these are the measures that should be taken by government for fiscal policy. The last one is the monetary policy. What should the RBI do to control inflation? So very simple, I have put it point wise, so exam may you just follow these points. RBI should reduce money supply. How? By increasing the rates of interest like bank rate, repo rate, reverse repo, SDF, MSF, etc. RBI also should increase CRR and SLR. Okay? And under open market operation, RBI should sell government security. So that means borrow money. Then follow dear money policy, contraction of money supply policy. It simply means increase the key rates of interest in the economy. Clear now? So to control inflation, we have both fiscal policy and monetary policy, and both should be combined to control inflation. Your exam in prelims, you will get this kind of options. You can even check previous year paper. Also you can refer to UPSC paper. This kind of questions are very common in prelims exam. Okay. So today we have discussed the topic of causes of inflation and fiscal and monetary policy tools, how they are used to control inflation. Okay. If you have any query, you can contact Bhadra IAS online, Nagaland Civil Service at 8638391721. Okay, and keep following our videos. We'll be coming with more topics and more discussion to make your exam preparation easier. Thank you.